Dividend growth investing involves receiving payments from companies simply for holding their stock. This investment strategy focuses on building wealth through consistent dividend payouts. Investors benefit from regular income streams derived from company profits. Dividend growth investing can provide a reliable source of passive income. Dividends are cash payments made by some companies to their shareholders. These payments represent a portion of the company's profits distributed among its owners. Not all companies distribute dividends. It depends on their financial strategy and growth stage. Dividends provide shareholders with a direct return on their investment, incentivizing long-term ownership. Dividend growth investing focuses on companies that consistently increase their dividend payments each year. This investment strategy targets companies demonstrating a commitment to returning increasing value to shareholders over time. Companies suitable for dividend growth investing typically exhibit stable earnings and strong financial health. Annual dividend increases can provide investors with a growing income stream and potential capital appreciation. Dividend growth investing requires careful analysis of a company's financial statements and dividend history. Dividend growth provides the potential for increased income over time. The increase in income is directly correlated with the company's dividends per share rising. Consistent dividend growth can significantly enhance long-term investment returns. Companies with a history of dividend growth often demonstrate financial stability and disciplined capital allocation. Reinvesting dividends can further amplify the compounding effect and accelerate wealth accumulation. Dividend growth investing provides a steady income stream. This strategy offers cash flow even when the market experiences downturns. Consistent dividend payouts can act as a financial buffer during economic uncertainty. Dividend income can be reinvested to further accelerate wealth accumulation. Companies with a history of consistent dividend growth often demonstrate financial strength and stability. Reinvesting dividends allows investors to purchase additional shares of a company. Purchasing additional shares with dividends increases the investor's stake in the company. The cycle of reinvesting dividends creates a compounding effect, accelerating wealth accumulation. With more shares, the investor receives larger dividend payments in subsequent periods. This compounding effect means that the investment grows exponentially over time. Reinvesting dividends can significantly enhance long-term investment returns. Dividend income can substantially increase over the long term. Consistent dividend payments can eventually cover significant expenses. With sufficient growth, dividend income may replace a salary. Reinvesting dividends accelerates the growth of income-generating assets. Long-term dividend strategies provide financial security and passive income streams. Dividend growth investing starts with researching companies that have consistently increased dividend payments. Companies with a proven history of increasing dividends are often referred to as dividend aristocrats. Dividend aristocrats represent a reliable history of increasing shareholder value through consistent dividend growth. Identifying dividend aristocrats involves analyzing financial statements and historical dividend data. Consistent dividend growth indicates financial stability and a commitment to shareholder returns. Investing in dividend aristocrats can provide a steady stream of income and potential capital appreciation. Consistent dividend payouts are often associated with companies demonstrating strong financial health. Profitability is a key indicator of a company's ability to sustain dividend payments over time. Business stability ensures a company can reliably generate earnings, supporting consistent dividend distribution. Focusing on financially robust companies minimizes the risk of dividend cuts or suspensions. Automatically reinvesting dividends maximizes the compounding effect. Dividend reinvestment accelerates the growth of both income and investment value. The compounding effect is amplified through the continuous cycle of reinvesting dividends. Reinvesting dividends leads to exponential growth, significantly increasing long-term returns. Dividend growth investing is a long-term strategy. This investment approach requires patience. The benefits of dividend growth investing unfold over several years. Consistent dividend increases are a key indicator of a company's financial health. Reinvesting dividends can accelerate long-term returns. Dividend growth investing focuses on companies with a history of raising payouts. Investing in dividend-paying stocks provides a source of annual income. Reinvesting dividends can further amplify investment returns through compounding. Dividend growth in stocks contributes to the overall increase in investment value. The combination of reinvesting and dividend growth leads to substantial long-term investment gains. Diversification is a risk management strategy that involves spreading investments across various assets. Concentrating investments in a single company increases the potential for significant losses. Diversification mitigates risk by reducing the impact of any single investment's performance on the overall portfolio. A diversified portfolio includes a mix of asset classes with varying levels of risk and return. Effective diversification requires careful consideration of asset allocation and correlation. Consistency in dividend growth should be prioritized over pursuing the highest yield. Sustainable dividend growth provides a more reliable income stream for investors. Chasing high yields can lead to investments with unsustainable or fluctuating dividends. Consistent dividend growth indicates a company's financial stability and commitment to shareholders. Reliable dividend growth often reflects a company's strong business model and prudent financial management. Focusing on sustainable growth helps mitigate the risk of dividend cuts or suspensions during economic downturns. High dividend yields that appear unsustainable may signal underlying financial distress within a company. Unusually high dividend payouts can be a red flag, potentially masking deeper solvency issues. Companies facing financial difficulties might artificially inflate dividends to attract investors, creating a deceptive appearance of stability. Due diligence is essential to verify the financial health of a company before being lured by seemingly attractive dividend yields. Optimal investment growth requires adopting a long-term perspective. Envisioning the investment horizon over extended periods such as 5, 10, or 20 years is crucial. A long-term investment strategy facilitates greater potential for substantial growth. Patience and a forward-thinking mindset are key components of successful long-term investing. Long-term investment strategies often outperform short-term speculative approaches. A common investment error is selecting stocks based solely on high dividend yields. Focusing exclusively on dividend yield neglects the importance of assessing a company's overall financial health. Companies' financial health includes factors such as revenue, profitability, debt levels, and cash flow. Ignoring these fundamental factors can lead to investing in financially unstable companies. Financially unstable companies may be unable to sustain high dividend payouts, potentially leading to dividend cuts. A comprehensive analysis of a company's financials is crucial for making informed investment decisions. Ignoring company fundamentals can result in investments in unsustainable dividend payouts. Investing in unsustainable dividend payouts increases the risk of investment losses. A thorough analysis of company fundamentals is crucial for making informed investment decisions. Sustainable dividends are supported by strong company performance and financial stability. Prematurely selling investments during market downturns can disrupt the compounding effect. Disrupting the compounding effect hinders long-term investment growth. Long-term investment strategies rely on the power of compounding to generate substantial returns. Maintaining investments during market fluctuations allows for potential recovery and continued growth. Dividend growth investing offers a gradual and secure method for accumulating wealth. This investment strategy focuses on companies with a consistent history of increasing dividend payouts. Consistent dividend increases can provide a growing income stream over time. Reinvesting dividends allows for the purchase of additional shares, further accelerating wealth accumulation. Dividend growth investing tends to be less volatile than other investment strategies. This approach is suitable for long-term investors seeking stable and predictable returns. Initiating investments with modest capital and consistently reinvesting dividends fosters significant long-term financial growth. Reinvesting dividends allows for the compounding of returns, accelerating the growth of the initial investment over time. Consistent reinvestment transforms modest beginnings into substantial financial assets over extended periods. The strategy of reinvesting dividends leverages the power of compounding to amplify investment returns. The power of compounding can significantly enhance financial returns over time. Consistent dividend growth further amplifies the positive financial outcomes. Compounding involves reinvesting earnings to generate additional earnings. Dividend growth refers to the consistent increase in dividend payments over time. The combination of compounding and dividend growth creates a powerful wealth-building strategy. Long-term investment horizons are essential to fully realize the benefits of compounding and dividend growth. Dividend income contributes to overall investment returns. Capital appreciation, or the increase in asset value, also enhances investment returns. The combination of dividend income and capital appreciation can significantly boost overall returns. Enhanced returns from both sources provide a more robust investment strategy. Dividend growth investing allows capital to generate passive income and accumulate wealth. This investment strategy focuses on companies with a consistent history of increasing dividend payouts. Dividend growth provides a stream of income that tends to increase over time. Reinvesting dividends can accelerate wealth accumulation through compounding returns. Dividend growth investing can be a reliable method for long-term financial planning. Dividend growth investing, when approached with discipline and patience, can be a pathway to substantial financial security. Consistent reinvestment of dividends fosters compounding returns, accelerating wealth accumulation over time. Selecting companies with a history of consistent dividend increases is crucial for long-term investment success. Thorough research and analysis are essential to identify companies with sustainable dividend growth potential. A long-term perspective is necessary to fully realize the benefits of dividends growth investing. Start small, reinvest, and stay patient. The results will surprise you. Don't forget to like, subscribe, and share this video with anyone who wants to make their money work for them.